What up, Hyperchange? Welcome to another episode. Today we're going to talk about new news from Tesla that the company plans to raise about $2 billion of fresh capital. This news totally caught me by surprise, and I think a lot of people. So I want to go through the mechanics of what Tesla is actually doing here, how they're going to raise the money, and then what I think they're going to spend the money on, why I think this could actually make a lot of sense. But, first I want to talk about the surprise here. First, this news broke earlier this morning. The stock was down in pre-market like 4 or 5%. Now, as I'm recording this episode, the stock is up like 2% for the day, so pretty big swing. The market's trying to digest this news because just 2 weeks ago on the Q4 earnings call, Elon Musk and Tesla were very adamant about not needing to raise capital. They were asked several times on the call if they would leverage their higher share price to dilute a little bit, strengthen their balance sheet, maybe accelerate growth plans. And the answer was pretty clear from Elon Musk and Zach Kirkhorn, the CFO, basically saying, we don't need money. We're spending money as fast as we can on R&D. Capital is not the bottleneck. We don't want to dilute. It doesn't make sense to dilute. So hearing them adamantly deny wanting to raise capital just 2 weeks ago, now seeing them raise capital, a little bit interesting, totally caught me by surprise. And if I did have a 0.1% feedback for Tesla, it would be maybe don't deny that you're going to keep raising capital and just be yes, we will consider doing, they should have given a more PC answer on the conference call, maybe yes, we will consider raising capital if, the circumstances dictate that it would be a good idea or something like that. Because, screw what Wall Street thinks and setting expectations for Wall Street. But just in terms of personal investors and, shareholders following the company, I was totally surprised by this and caught off guard. And if, Tesla was signaling we have really strong internal operating cash flow, that's going to be enough to fund our growth ambitions. So it doesn't make sense to dilute. Now we're seeing them dilute, just mixed signals. But anyway, I don't think it's a big deal. Let's dive into the mechanics of what's going down. So Tesla puts out this press release here saying that they intend to offer about $2 billion of common stock in an underwritten registered public offering. They've also granted the 30-day option to purchase up to approximately $300 million of additional common stock. Elon Musk, the CEO, will participate by buying 10 million of stock in this offering. So Elon Musk buying in, although out of 2 billion, 10 million is not much. Larry Ellison, also on the board of directors, will purchase up to $1 million. Also doesn't really matter because he's like a billionaire, but they throw that in there. Cool to see the directors buying in, I guess. But then they say the proceeds from this stock sale are expected to be about 2.3 billion before discounts and expenses. So at the end of the day, what this translates to is Tesla is selling stock and they're going to raise about $2 billion is going to go into their bank account from selling stock. So you can actually look at this SEC filing I'll put a link to, which is the preliminary offering. So as you can see, 2.65 million shares is what they're offering here. Goldman and Morgan Stanley joint or co-leading the deal with a bunch of other banks there. But the important thing here to think about is 2.65 million shares. So this is not much stock Tesla's selling. And this is where I think reading in between the lines, what happened here is when Elon Musk and the CFO, Zach Kirkhorn, were saying, we don't need to raise money, the stock was actually at $580 per share. The conference call was a huge hit. Shares went to 700 or 600 the next day, then 700, then 800, then 900. Now they're around 767 when they put this out, actually in the 780s as I'm recording this. So that's like a 34% move since they said they didn't want to raise capital. So the stock price has gone up another 34%. So that makes it, they can raise way more money with diluting less. So from that perspective, this is a really well-timed move from a financially timing perspective in a lot of ways, because if you think about it, for them to raise $2 billion, a year or two ago, they were diluting the company 5 or 6%, which is pretty significant dilution. But now with a little over 180 million shares outstanding, they're selling about 2.65 million shares. That's about 1.5% dilution. So very small dilution for $2 billion of cash. So I think strategically from a long-term perspective, leveraging this super high equity price to dilute this tiny amount, it could make a lot of sense. Although I just in the back of my head, maybe you can tell, I'm just a little bit bummed because I think Tesla shares are worth their weight in gold or more. They're just so valuable. You just do not want to dilute unless you have to. But anyway, this will give the company a bigger cushion. So we'll talk about that in a second, but I do think it is worth, actually the stock's at 790 as I'm recording this episode. It's crazy. Shares just keep climbing on this news. I guess the market is pumped that Tesla is strengthening its balance sheet. And so I wanted to dive in because also something else happened that was pretty interesting today. Tesla put out their 10K, which is their annual filing about with all their financials. It's 300 pages long, talking about what's going on with the company. An amazing read. I'll put a link in the description if you haven't read it already, but just so fascinating. So many tidbits in there that I haven't even discovered yet. But one of them is extremely important and has a lot to do with this capital raise. So this is actually something I haven't seen reported anywhere yet, probably will be after this video, but Tesla has significantly upped their CAPEX guidance. And so that is a big reason that I think they could have decided to do this capital raise. So if you go to every single quarterly filing, Tesla basically is just an SEC rule, has to disclose how much capital expenditures they're expected to spend on an annual basis for the foreseeable future, like the next couple years. Capital expenditures are investments for future growth. If you're a rapidly growing manufacturing company, the SEC wants you to disclose that so investors can get a sense of, okay, well, how much money you're going to need to spend on all these factories you're building, on all this new tech you're developing. So Tesla discloses that every quarter. If we go into page 49 of the most recent 10Q, you can see that they guide here. We currently estimate that capital expenditures will be between 2 to 2.5 billion annually for the next 2 fiscal years. So Tesla's basically saying our annual guidance for CAPEX is 2 to 2.5 billion per year for the next couple years, for 2020 and 2021. We'll now go to the 10K. And if we go to page 41, you'll see they have totally changed this guidance. We currently expect our average annual expenditures in 2020 and the 2 succeeding fiscal years to be 2.5 to 3.5 billion. So Tesla has upped their CAPEX guidance from 2 to 2.5 billion to 2.5 to 3 billion. At the midpoint, that's 2.25 billion a year to 3 billion a year. That's an average of like 600 something million a quarter to 750 million a quarter. So basically spending, almost an extra billion per year on future growth investments. So a pretty significant upgrade in the amount of CAPEX they're planning to spend. And so if you start thinking, reverse engineering that of, okay, Tesla wants to invest in growth, they want to keep a cash cushion for a recession. It makes sense, that 2 billion, 1 billion increase each year is 2 billion. They just raised 2 billion. So they basically just offset that growth in CAPEX with this capital raise. So going into Hyperchart's world, you can follow along hypercharts.co/Tesla. I just wanted to hone in a little bit more on what Tesla's CAPEX trend has been so we can see a little bit more about what they're thinking. So this is Tesla's cash flow chart on a quarterly basis. We have operating cash flow, capital expenditures, and free cash flow. Let's just start by saying, actually, this is worth highlighting because I think in Q1, Tesla's poised to lose a bunch of cash. So even though Tesla's cash balance has been going up, as we can see right here, they had about 6.3 billion in cash, up from 5.3 billion, all-time highs for record cash balance. What has happened every single Q1? Cash has gone down after Q1 in a lot of occasions because, as you can see, they produce a negative operating cash flow. And so Tesla, Q1 is a seasonally weak quarter for the automotive business. Not a lot of people are buying cars. Tesla's typically building more inventory, and they're selling in Q1 to sort of build up inventory for the year. Additionally, less sales, but all of their fixed costs. This means that Tesla loses a lot of money in Q1 of the year and then starts making it back throughout the year. As you can see, that's been the historical trend. If we look at their operating cash flow, Q1, always a pretty weak quarter, lost about 400 million in Q1 2018, 640 million in Q1 2019, and that's just operating cash flow. That's not even taking into capital expenditures. So I think Q1 of 2020 is going to be another quarter of a loss of operating cash flow, so it's important that they have a cushion there. Just wanted to mention that. But now let's get into the more important part, capital expenditures. How much is Tesla spending on every quarter for new growth? So as we can see, Tesla's significantly scaled down their CAPEX since 2017 here, when they're spending, $1 billion a quarter, almost over $1 billion a quarter for a couple quarters to ramp the Model 3 and get that off the ground. And this was when they were having a bunch of issues ramping the Model 3. They had to build the GA4 in the tent. They were missing all their deadlines. So they were sort of overspending and sort of panic mode. Since then, Tesla's got a lot better at manufacturing and has, been guiding in their quarterly letters. CAPEX per unit of capacity is going down by 50%, by 65%. On these new production lines, Model Y at Fremont, Gigafactory 3 Shanghai. So Tesla's getting much more capital efficient at building out their production lines. So that's one thing that we're seeing here play out on the CAPEX thing is they just need less CAPEX to build out the same production lines because they're getting more efficient. But they're still going to have to ramp this CAPEX significantly. And if you think about the guidance here, 412 million seems like, okay, they're kind of growing CAPEX. This is nowhere near what Tesla's guiding. 3 billion, the midpoint of their CAPEX guidance divided by 4, 750 million a quarter. So this number is going to have to go all the way back down, here on average 750 million per quarter for the next 4 quarters. So Tesla, they're basically guiding for a significant increase in capital expenditures. Now the question is, what are they going to spend that money on? Model Y ramp. We know they are going to significantly increase Model Y capacity from basically 0 test production runs at the start of this year towards ramping up to 100,000 vehicles per year capacity at Fremont alone. That's going to take significant CAPEX at Fremont. Then we have Gigafactory 3 Shanghai, where they're building out the Model 3 production line. They're also building out a battery facility. They're also going to start building out a Model Y production line there for 2021. So you think about all this production expansion that Tesla is doing, 2 factories around the world, actually 3 factories around the world. When you consider that Gigafactory Berlin is also starting construction this year, they're going to have to start spending CAPEX there, ramping throughout the year to get ready for production there in 2021. So huge ramp ups in vehicle production capacity that are going to require significant CAPEX in 2020. The other big thing that they haven't really mentioned here, and that this is kind of my personal theory of what Tesla's going to announce and spend at least $1 billion or $2 billion on over the next couple years, is bringing battery cell production in-house. And so this has been a huge theory I've talked about on the channel. Many, in the know Tesla blogs have been referencing it, but this theory that Tesla bought Maxwell Technologies is going to leverage this dry battery electrode battery manufacturing breakthrough to basically start building their own battery cells. It's not like they're going to cut out Panasonic, who's their current battery partner. They just need more capacity. So my guess is they're going to keep expanding with Panasonic, getting those 2170 cells at Gigafactory Nevada, keep buying cells, 18650 cells from Panasonic Japan for the Model S and X. But then for these new products, like the semi-truck, like the Cybertruck, I think they're going to start potentially using these in-house produced battery cells. And so if Tesla, Elon Musk has said Battery Investor Day is going to be extremely important, and this big takeaway, the news to drop at Battery Investor Day is we're going to go from producing 50 gigawatt hours of batteries to 1 to 2 terawatt hours of batteries in the foreseeable future in the coming years. That's like a 50x increase, or 20, 30, 40, 50x increase in the amount of batteries they need. So it's not just like, even if they double with Panasonic, like that's nowhere near enough the capacity. And that's what Elon Musk has talked about, over and over again on the conference call, is our biggest constraint on growth. Tesla basically sells every car they build, is just how many cars we can build. And the biggest limiting factor for how many cars they can build is how many batteries they have. So that's also why they've been so kind of like delayed on the semi-truck, is because the semi-truck requires way more batteries than a Model 3 or Model Y. And so they just don't have enough batteries to build a bunch of semi-trucks yet without diverting supply from Model 3 or Model Y or other vehicles. So the biggest limiting factor on Tesla right now has been batteries. How do we get enough batteries? And so I think if they're going to bring cell production in-house, they're going to have to spend billions of dollars to build out new battery production lines. And that's, how else do you expand capacity by such a dramatic amount? You have to spend the CAPEX to build out these battery lines. So my prediction is that Tesla, although 2019 was a year of building up cash, 2020 will be a year of significantly spending cash. Like the core business operationally will have very strong cash flow, but they're going to want to just have a huge ramp up of capital expenditures. And I think the part of that nobody's really pricing in or realizing yet is at Battery Investor Day, they're going to be like, here's this crazy new technology, here are the new cells we're building, and we're going to spend $2 billion to build this massive factory expansion, either at Nevada or somewhere else, to start building our own cells. I think it's just going to take a ton of money, ton of CAPEX. That's what they're going to do. And then that brings up another point, which is Gigafactory Austin. Or Gigafactory Texas. I'm hoping it's Gigafactory Austin, because I was just in Austin at the Fully Charged event. I thought such a cool city. But it sounds like Tesla's getting ready for Gigafactory Texas, which I think they could build a Cybertruck there, Cybertruck pickup made in Texas. Like, I just think that's an awesome idea. And apparently there's rumors that Tesla had previously even considered Texas as a site for the Gigafactory when they were eventually chose Nevada. So they've already seems like I put some thought into building a huge factory in Texas. And so if they want to accelerate their plans, they're doing China, they're doing Fremont, they're doing Berlin, and now they want to do Texas too. I mean, we're talking a ton of CAPEX to expand production capacity. And so that is another thing I think could be playing into this. It's not like they're desperate for cash and they couldn't have spent, their money on all these growth initiatives by themselves, but it's just that if you want to spend like crazy on all this stuff and still have a cushion for a recession, leveraging your extremely high share price right now to raise a little bit of equity just strategically makes a lot of sense, a little bit more risk averse. A lot of us a year or two ago were like begging Tesla to raise money because they were on like such a shoestring budget, and it just seemed like they had no cushion if things went wrong. So, if you take a step back and look through that lens, it's like, wow, if you're really a long-term investor concerned about the safety of the company, this should make you sleep a lot better at night and feel better about the overall health of the company. I want to go back to hypercharts really quickly just to show you the cash flow on an annual view, just to kind of play off this point. Operating cash flow perspective, Tesla's business for the past 2 years has, from their core business of operations, been pumping out significant cash flow, 2.1 billion, then 2.4 billion. I think this will actually go up even in 2020. So that gives them, a lot of ammo to spend on CAPEX. Even if they spend, 3 billion on CAPEX, that could be all muted out by operating cash flow, which I think is really, really exciting. But this does, on an annual basis, goes to show that Tesla's CAPEX for the past 2 years has been sort of artificially depressed, and it's going to go way closer back to these 2017 levels, or maybe, around here for 2020. And then we talk about the free cash flow. I think the free cash flow number could actually maybe even go down a little bit in 2020 despite higher operating cash flow because of these higher capital expenditures. But just wanted to point that out. Anyway, that wraps up this episode. At a high level summary, Tesla is raising $2 billion by selling about 2.6 million shares of stock, 1.5% tiny dilution. This gives them more dry powder and ammo to sort of accelerate turbocharge growth plans of expanding vehicle productions with new factories. I think gives them a bunch of money to invest in future battery cell lines, which they're going to announce at Battery Investor Day. And then while doing all these crazy growth things, gives them a bigger cushion if a recession were to hit. And you think about what's happening with the coronavirus right now. I should have mentioned this earlier, but like, you know, that's totally stalling what's happening in China. I know they have reopened the factory, but, you know, if that continues to get worse and then something happens in China and they have all these cars and expenses to pay, but they're not getting revenue, like a lot of things can happen. And so this gives them more of a cushion to sort of, you know, not be in trouble financially and dilute on horrible terms if the share price is plunging because sales are down and then they're forced to dilute. That's a lot worse than just this tiny 1.5% dilution when the share price is super high. So anyway, those are my 2 cents. Would love to know what you think in the comments below. Did this catch you by surprise? What are your thoughts about the capital raise? Huge shout out to our Patreon supporters, producers, fun in the channel. See you guys next time. Peace.